All right, so this is what you would be given. A comparative balance sheet. Remember, you need 2 years. And then out to the side, I went ahead and put the change for the year. You wouldn't necessarily be given this. Sometimes you are, sometimes you're not. So I went ahead and did that just so we didn't have to calculate it, everything. So for example, like AR, and notice, I need to really make this point right now, is the book does it opposite of me. It's just in my personal nature to read things from left to right like we read everything else. A lot of times in finances, they go backwards. They start with the most current year and then work backwards. So you're going to see that, and it just messes me up. But I went ahead and left it like this just because it's the most familiar for me. So I read it with the last year being the most recent. So remember that the book is going to have the left over here being the most recent. So they're going to have 2017, 2016, or whatever years they use. So here, the AR went from 47 last year down to 36 this year. So there was a net change of $11,000. And I did that for all of the balance sheet items. And then down below, we have our income statement. And then finally, we have our notes. And these are the primary notes. We'll get down here to the direct method notes in a little bit. But these are the primary notes we're going to use to do the indirect method for the investing and the finance. All right, so let's just get into it. Remember, as we said in our little write-up here, that the first thing you always start with is net income. So I would have when you're making this financial statement, start off with your net income. And we have our operating section, section number 1 out of 3. Net income, $80,000. Then we said, okay, we need to look for 2 items on the income statement, depreciation, and is there a gain or loss? So let's go ahead and look for those. Go down to the income statement. And depreciation would be in the expenses, and sure enough, we have one. $17,000. And remember, if I want to get rid of that $17,000, I need to act like it's not there. So if it wasn't there, my net income would be $17,000 higher because those expenses bring the net income down. So what I'm going to do is simply add back in the depreciation expense. I'm going to make it a positive. And that's what my notes tell you to do here. Whatever the depreciation is, add it back in. Now I'm going to look for any gain or loss. And what we have is a loss. And we're going to be able to explain that in a little bit. But for right now, it's just enough to know that we have a loss. And on my little notes, it says, okay, if there's a loss, that's the second item, we need to add it back to cash. And hopefully that makes sense, because a loss makes our net income go down. Well, we want to pretend it didn't even happen, because losses don't affect cash. So I'm going to put my loss on here as a positive to cash. Now we're going to look at, once we've done that, once we have looked at these 2 items, we're going to come down to the other part, and we're going to look at our balance sheet, all the current assets and all the current liabilities. Okay, so let's go back up to our balance sheet. And remember, we leave everything out except cash. Cash is going to be here, but I'm going to put it maybe in yellow, and we're going to know to come back to that at the very, very end, because this whole statement focuses on cash. And then as I go through and I do something, and I've touched on each one of these, I'm going to make it red, because everything needs to be touched, but only once. So AR went down by 11,000. And in my little notes, it says, okay, if your current asset went down, which is the second one, you need to add that difference back to cash. And let's see why, so we don't have to always memorize the chart. If our AR went down, that usually means that people paid off their bill. So I got money. So when the AR goes down, our cash went up most of the time, unless you're told differently, like they didn't, their account went into default. It's going to be the same then for every current asset. So, okay, let's look at prepaid. Our prepaids went up, just the opposite. Well, if prepaids went up, that means I had to prepay, I had to pay for something in advance. It's not showing up as an expense because it's not an expense yet. So I need to show that I spent money. So when my prepaids go up, I paid $2,000. So my cash went down and it's not showing up on the income statement. Then our last one, inventory. Inventory is it's just like any other current asset. When inventory goes down, well, that means I expensed out some of that inventory as cost of goods sold, but I never replaced it. My inventory went down, and so I didn't spend the extra money to replace it. So my cash actually went up in comparison because the income statement with cost of goods sold is kind of assuming that I replaced it, and I had some extra laying around, and I didn't pay for that extra $10,000 this month. I paid for it a long time ago, and it doesn't matter what I paid for a long time ago. It matters what happens right now. And right now, I didn't spend that money, so I'm going to add it back into cash. It's easiest just to remember that if your current assets go down, your cash goes up. That's the easiest way to kind of think about it when you get started. And if your current assets go up, that means you spent money and bought some stuff or your clients didn't pay you, and then your cash goes down. So then we go to my little cheat sheet, and it says once we've done all the current assets, we go to the current liabilities. So let's go down here. All of these are now going to be red. I have done them. And to help remind me that I've done them, I'm going to mark them out. I'm going to go down to my current liabilities. So that would be the account payable and the wages payable. So let's do the account payable. My account payable went from 33 down to 23. And hopefully the only reason that it went down is because I paid off my bill. And if I paid off my bill, that means my cash went down. So, and this solidifies that here. If your current liability goes down, that means you lost money because you paid it off. You paid off your bill. So I come down here, I have a decrease in accounts payable. My account payable went down. That means I paid out money. So I need to show that I paid out money. I lost cash. And then my last one here, my wages payable, it went up by 1,000. So in the short term, I saved some cash. So my expenses would have showed extra cash being spent, but it really wasn't. So whenever current liabilities go up, that means my cash goes up. Now, as that is all that we had for current liabilities, I am now done with the operating section. So over here, I want to take my 80,000 and then combine it with everything that I have here. And what I went ahead and did is just I added all of this up, and it comes out to be 28,000. So 80 plus the 28 here, I had net cash provided from, I'll put that word in here, operating activities, 108,000. Operating activities are your day-to-day things. These are things that change day to day. Net income, everything on the income statement, day to day, and then your current assets and current liabilities are all day-to-day things that go up and down. So I actually brought in $108,000 this year in cash. So I have an extra $108,000 to do stuff with. For the other two, investing, I can buy some equipment perhaps, or the financing, I could pay off some debt. But I have some money to work with. All right, so we're ready now for number 2, investing. Now, when we get to the investing, we're always going to have to look at our notes because to explain. The operating, you don't really need to look at your notes. Those are the day-to-day. We can just look at the number change. With the investing, I have to be more particular. I have to look at my notes. I have to see if my land changed, why did it change? Did I sell land and get something else? Or did I sell land and get money? Or did I buy land? And how did I buy it? Did I buy it on account? or did I pay it with cash? We have to know, we have to look at our notes. All right, so land. Land went down for the year. So that means I got rid of some land. All right, why? What happened? So I come down here to my notes, and it tells me here that land was sold at book value for cash. Okay, I'm going to mark that one out because I'm going to be using it. Book value means I didn't have a gain or a loss. So whatever the difference is, that's how much cash I brought in. Because I could have sold the land for a gain. Just because I got rid of 15,000 in land, what if I sold it for 20? We wouldn't know that just by looking at this. But it tells me I sold it for book value, so I sold it for what it's worth on my books, 15,000. If I sold the land, that means I got money. So I'm going to come down here and show that. I'm going to show I had a sale of land, and my cash went up by 15,000. And that explained all of that 15,000, so I can get rid of it. Now with the buildings, nothing happened with the buildings. So I don't have to do anything with that. I can just skip right on through that. And remember, we don't do anything with accumulated depreciation except help prove some numbers. Now, when you get to connect, and we're going to see this when we get there, they're not going to be necessarily as nice as I am, and I give you the amounts that it was sold for. They're going to actually make you figure it up. And so you will kind of use accumulated depreciation just to help figure some numbers, but never will it go over here into your actual statement of cash flows. You'll see when I'm talking about a little bit. All right, so the equipment had several things happening to it, or at least more than one. So when we go up here and look at this change, we're going to be notating this change in a couple. It's not going to be just 22,000 in a one-time transaction. The total is going to be 22,000, whatever it is. So we're going to have to prove this $22,000 change with these transactions. So let's see if it works. Okay. If I sold equipment for $20,000 cash, and it had a cost of $25,000, a book value of $21,000. Okay, so we got some different stuff going on here, and we got to think of how do I know how much cash was actually involved here? And we need to be able to provide the journal entry. The journal entry is going to be important. Let me see if I have these. Nope. Okay. So we're going to put these right here on this page so I can begin to see what's really happening here. And then I'm going to get rid of them. I'm going to keep putting the same journal entries here. So if I was doing this journal entry and I sold equipment for cash of $20,000, that's going to be the important thing. And then I had this, it said it had a cost of $25,000 and a book value of 21. So if it cost me 25 and it's still worth 21, that should tell me how much accumulated depreciation that I'm getting rid of that had accumulated. That would be 4,000. Because if it's still worth 21 and I bought it for 25, I've only accumulated 4,000 in cash or in accumulated depreciation. Now, since I don't know what the gain or loss is yet, I'm going to come down here and credit my equipment. I'm going to credit the equipment for what I bought it for, what it's on my books. So right now I have almost the entire journal entry done, except my debits don't quite equal my credits. And that's because it was worth 21, but I only brought in 20. And I had a loss, therefore, I had a loss on disposal of $1,000. And looky here, that's where this guy comes into play. So I have just solved where that one came from, where the loss came from. It came from this journal entry right here. Now, I can come up here at 25,000 in equipment. I come up here, and part of that 22, part of it was a negative 25. So you think, hey, wait a minute, we went up 22 and this is showing down 25. Well, we're starting to explain it, but we're going in the wrong direction right now. But hopefully this number out here, this next number, will help balance it out. So I'm supposed to explain positive 22. And so far, I'm not there yet. I'm actually went the other way. I'm explaining negative 25. All right, so, and then the last thing I want to look at is this number. This is what goes on my statement of cash flows, 20 grand. I brought in 20,000 on the sale of the equipment, not 25, even though that's what it was worth. I didn't bring in that. I put down what I brought in, the 20,000. Then I come over here and I see, okay, I've got one more item that affected cash. It says I bought equipment for 47,000. So I would debit my equipment for 47,000. And it says I bought it with cash for 47,000. So this equipment, this made my equipment go up 47,000. So over, I'm gonna put in an equation now. Negative 25 plus 47. If I add those two together, I have now that 22,000. I have explained why the equipment changed by 22,000 because I sold some and then I bought more, and that's why the difference here is a net 22,000. So I have now explained my equipment, and then therefore we always get rid of the accumulated depreciation as well. So I'm going to come over here to my statement of cash flows because I just entered in this number. Now I just got to do the cash part. The cash is the same in this case. It wouldn't always have to be. Maybe I paid some down and some on a note. And if that case, it's whatever the cash is. What did I pay on it right now? And on this one, I just paid it all. So that's all I had on the investing. So the investing, I can go ahead and total up the difference. And this one actually is a negative. So I spent some of the money I had raised up here. And so we call this net cash used by investing. And then I'm gonna get rid of these. These are now done. So I just have 3 things left that I need to look at. You would want to keep these, but I'm gonna, yeah, we can keep them going down here. We have room. So our last pieces is looking at our long-term liabilities and our long-term owner's equity. Okay, so it says notes payable. Notes payable went down by 4,000. I look at my note, my little notes down here, and it says, yep, the reason it went down is because we paid on the note. So that's a pretty easy journal entry. Note payable went down 4 grand because I paid cash. So I've explained the note. The note is now done. And I show that over here in the financing activities. Payment on a note. I paid money, cash is going out. Bonds, same kind of thing happened with bonds. My bonds went down by 94,000, and it tells me that cash was paid to redeem the bonds. All right, so if cash was paid, I can get rid of my bond number. I can put the bond now into my statement of cash flows for that 94,000. The redemption or payment of bonds, either one would be fine. Now, common stock, no change. So if nothing happened here, I can just cross this one out, nothing to put on the statement of cash flows. The last thing is the retained earnings, and it went up 62,000, but let's figure out why it went up 62,000. If you think of closing entries, and as long as nothing else happened to retained earnings, like sold treasury stock at a loss, but you would have to be told that. Let's assume nothing else happened. The 2 things that go into retained earnings when you close things out are your income summary, which is your net income, and dividends. So if I started at 30 and I added in my net income of 80,000, how much in dividends? So if I've just explained 80 of the 62, so I over-explained it. How much in dividends then do I have to pay to get back down to 62,000 change instead of 80. And if you can do the math in your head, that means I paid 18,000 in dividends, which is exactly what my notes say. Now in the book problems, they won't give you how much you paid in dividends necessarily. They're going to have you figure it by doing the method we just did. So this goes away. I can do a journal entry that shows I had dividends being debited, and I could just say retained earnings being debited by 18,000. And my cash was credited by 18,000. And then since cash was paid, I need to show that payment of dividends for 18,000. Now that's everything. I've done everything I needed to. I can put this one is now done. All of my items are red, except the very last item that I'm going to come to now. So we have our total financing. We're going to add them all up. So when we add all these up, it's a negative 116. So we can see that I actually have spent more than the 108 that I brought in. So my cash should have went down. And if I look over here, it did go down. Now we can just finalize it and say, okay, did I do it right? Beginning cash was 90. When you add up the three yellows, the 108, and then minus the 12, minus the 116, you should get negative 20,000. And that just happens to be the exact same as this, which it always should be. And then when you add up these two together, 70 grand, that's what my cash is here. So I've explained why the cash went down $20,000.